Technology is an amazing thing. It allows us to be able to communicate right now. You guys are watching this video just a day after I filmed it in real time, and we can order things online, we can pay all of our bills online, but there are some downsides to all this convenience, guys. There's something truly terrifying that I found out today, that mortgage lenders, not only do they use your entire, credit history, your financials, and all these things to qualify you to see if you are credit worthy enough to buy a home, but now it's getting to the point where they have a new software. It's called Sales Boomerang, okay? And this software can do things like find out big life events that you might be having, like maybe you got married, maybe you had a kid, maybe you had a heart attack, maybe you moved, maybe you got divorced, maybe a loved one close to you recently died. Now, those are just some examples that this article gave of what this software can do. Basically, guys, this sounds crazy because not only do these guys take into consideration your entire financial life of whether or not you should get a loan, now they're starting to take your personal life into consideration as well. That's why this is scary to me. A lot of those things that I just mentioned should not be part of your credit worthiness or affect your ability to borrow and pay back a loan. Hold that thought, guys. We have one for sale here. And by the way, we're over in Miami Shores again. I come over here about once a month because I wash my Jeep over here. And this is a new section we haven't walked through yet, so let's see how much this place is. Definitely well over $1 million, I'm sure. Probably closer to 2 or maybe even more. Now, guys, I don't know about you, but I don't want any lender worried about whether one of my family members recently died, or if I had a baby or not, or something like that, to determine whether or not I'm worth giving a mortgage to. And I'm sure that's also going to affect the rate they're going to give you as well. So talk about discrimination, right? First of all, discrimination is against the law when it comes to giving loans and things like that. And that's part of the reason Bank of America is now offering this zero money down loans again to minorities to try to rectify supposedly all the wrongs that it's made in the past. But guys, this is just another wrong coming from the lending industry that definitely shouldn't be allowed to happen. So I don't even know how this is legal, because none of these things should be considered when it comes to your borrowing power. I understand looking at your credit score, and if you pay your bills on time, that's a given. I understand looking at your income, because that definitely affects your ability to repay a loan. But when it comes to familial status, guys, and things like that, that's where I think they're definitely crossing the line here, and we're getting into dangerous territory when lenders are going to start using your personal life to determine whether or not you deserve a loan. So let me know what you guys think about that, if you knew about this already, because I certainly did not. Today's Labor Day. Happy Labor Day too, by the way, as I'm shooting this video, and I just found out about this, guys. But apparently this is not going to be used just for lending decisions. It's also going to be used to have the lender stay top of mind in your life. So for example, they have it where they have a notification system that will go out and congratulate you if you just got married or something like that. Another example they give here is if you have a divorce, the lender will reach out and provide customers with options with dealing with the mortgage while going through the divorce. I don't care how they use it, I just think it's wrong. That's my opinion, and you guys might differ from that. But let me know what you think. I don't think they should be sticking their nose where it doesn't belong. They can even go in there when your kid graduates from college, for example. They can suggest ways for you to downsize your loan and your living arrangements. So they're trying to help you, persuade you in ways to run your life based on what's going on. So last time I checked, this is unsolicited help that no one's asking for. So how do they have the right to pry into your life and tell you what to do with your biggest financial assets, aka your real estate, and based on your life decisions? That's for you to decide, okay? Nobody else, including your lender. Now, speaking of lending, guys, it is no surprise that it is becoming very difficult for many millennials and people my age and younger to save for a down payment for a home. Because not only are homes more expensive than ever, but inflation and the cost of everything that we need to pay for nowadays is just nuts. And trying to save money on the side while all this is going on is harder than it ever used to be. One thing people argue against the housing market of why things are so strong now and why they're going to stay strong into the near future is because millennials are at home buying age, and many of us have the need and desire for buying a home now. Well, that's great if you can afford it, because most of them, I think they can't, guys. Got another one for sale here. Now, why do I say if they can afford it? It's because 3 out of 4 millennials right now have non-mortgage debt of some kind. Most of them have student loan debt that is literally over $100,000 in a lot of situations, guys. The average student loan debt for most millennials is about 117 grand. So imagine that's bigger than probably their parents' mortgage ever even was. And you have to compete with that, and the interest rates are usually much higher than a mortgage to pay this thing off. And on top of that, you're paying all-time high rental prices if you live on your own, all-time high food and gas prices as well, and a broken economy essentially. So it's going to be extremely difficult for millennials to save any kind of reasonable amount of money to buy a home. And 30% of millennials surveyed think they're never going to be able to afford a home because of this crushing debt situation that many of them are in. So that's very sad. That's where I think it comes in, like we talked about a couple videos ago, of parents and grandparents helping their children and grandchildren get into homes, because in some cases that might be the only way they're ever going to have a home. So I'm not saying it's the right thing to do or the wrong thing to do, but the reality is some people might not ever be able to even do it if it wasn't for the help of their family. So that's how nuts it's getting right now, because people in their generation, a lot of them could afford a home based on the salary in those days and just get by on what was being offered, guys. We don't even have to go back that far in time to a time when people could make enough money where just one person needs to work and mom can stay at home and take care of the house and the kids. So obviously those days are over. Now people are struggling making it with 2. But the strange thing is I'm coming across a lot of conflicting information, because then I ran into this article while I was researching this video that said it would take the average millennial right now about 4 years only to save a down payment for today's average price home, or the median price home, which is about 400 grand, $413,000, okay? And they're saying it would take the average millennial who's making, on average, get this, $85,000 a year to save for a 20% down payment. So first of all, I want to know out there, how many of you guys watching my videos are millennials, and how many of you make $85,000 a year or more? Because according to this article, they're saying that this is the average and it should only take you 4 years to save for a down payment. Now, I'm willing to bet that most of you don't make that much, and the fraction of you that do probably have this large student loan debt to pay back as well. So there's that. And then, even if it takes 4 years, guys, say you don't have a dime saved and you're going to start saving today, and it'll take you 4 years to save that money, where do you think home prices are going to be in 4 years? Now, if we have a big crash, it could be lower than they are today, but they also could be higher than they are today. We could have a small crash or no crash at all, and things just go down a little bit, and then in 4 years from now, they're even more expensive than now. So who knows? I just think that the odds are not stacked in our favor in general. If you guys make this kind of money, then you should definitely be able to buy a home within the next few years if you're smart with your cash and you put enough of it away to save a sizable down payment. And remember, that's with a 20% down payment that they're talking about here. In a lot of cases, you don't need a 20% down payment to buy a house. If you're going to be buying a condo or an investment property, then yes, usually you'll need 20% or more. But if you're just buying a single family home like you see behind me here, and it's going to be your primary residence, there's a lot of different lending programs out there where you can get in for less than 20% down. But if you can put 20% down, it's always better because you're going to have a lower mortgage payment and you won't have any mortgage insurance payment either. So those things will save you money each month and get you the best deal possible. I wasn't sure how many properties we were going to run into for sale or for rent. This one here is for rent, since we never walked over here before. But that's already 3, just about 10-15 minutes in. A few weeks ago we talked about electric cars and how the new Inflation Reduction Act is giving people these tax credits, which don't really do anything anymore because a lot of these manufacturers raise their price by the amount of the tax credit. But we're not going to get into that part. I want to talk about something else related to electric cars, which is that there are now 17 states that are now faced with this decision of whether or not they're going to adopt California's new law where all the new cars sold by the year 2035 need to be electric or not. Now, I don't know which all the states are, but some of the states are Washington State, Massachusetts, New York, Oregon, and Vermont, Colorado and Pennsylvania as well. And all of these states are either looking at adopting similar rules or exactly the same rules, or maybe being a little bit more lenient. And of course, this is becoming more of a political statement and argument more than anything, which obviously it should not, but it is, guys. But some of these states have legitimate concerns about adopting these electric cars. And one of the guys who's against this in Minnesota said that when you have an electric car in the wintertime and it gets very cold, we already have reduced range on these electric cars, but the extreme cold makes the range even more limited. So, you know, this is great to have a Tesla and all of this if you live in Southern California where all year round it's 75 degrees. But when you live in Minnesota and the winters are 6 months long and you regularly have days that are below 0, how well is that electric car going to hold up? On top of the fact that, you know, there's not really the infrastructure in place to actually have a decent charging system for a lot of these electric cars either. So there's a lot of pushback against this movement right now, and rightfully so, because there's a lot of things that just haven't been ironed out yet, guys. I mean, the couple of things that I would say about it is 2035 is still a long ways away. That's 13 years from now, guys. So we've seen how fast technology can change in today's world, and what's to say that in 13 years from now they might not come up with something vastly superior to an electric car? I think that's possible. Who knows what that could end up being? They could invent that just 5 or 6 years from now, and it's something that we don't even know about yet. So there's that. And the other thing that I keep wondering about all this electrical car stuff is if it was so good, then why aren't people just lining up to get one of these things? Besides the cost, obviously they're expensive, but all new cars are expensive nowadays, let's be real. So it's not that it's just the cost, but if these cars were so great, then everybody would be lining up to get one and literally everyone would want one. But that's just not the situation. And I think the reason that is because it's really not that appealing so far. And even me, I'm not against electric cars, but I can tell you right now that from what I've heard about them, I don't want one, okay? And it would definitely really inconvenience my life to have one, and it will cost me more than the car I have right now on top of that. So I'm paying more for way less convenience. So the thought of having an electric car is definitely not at the top of mind for me, that's for sure. And the last thing I will say about it is, you know, why is this something that needs to be forced? Like, I understand that they're trying to help and save the environment, but anytime you try to force anything, it seems like, no matter what it is, it just ends up creating more pushback than anything else. That's what it seems like to me. It seems like when you make a law or a rule against something, then it creates the opposition, so to speak, of people that are just against it because it becomes politicized as well. So that's the other argument to it. So instead of these states saying, oh, you need to have nothing but electric cars by X date, why don't they start making electric cars go further on a charge and make them cheaper and make it so it doesn't take a long time to, charge the vehicle up, like you're stopping for gas, one of those examples. There's a lot of issues with it that still need to be ironed out. And instead of focusing on those things, they're just imposing deadlines. So write down Robert Kiyosaki, Jeremy Grantham, Michael Burry, and Harry Dent are all big financial guys that are calling for an overall market crash. And they're mainly referring to the stock market, but we'll get into in a minute on how the stock market coming down can also affect the real estate market as well. Now, I've been following Robert Kiyosaki since before I even started this YouTube channel. I listen to his Rich Dad radio show every week, and I still remember that back in 2018, guys, he was calling for this same crash, and essentially what happened is it never happened. Now, is it because he was wrong and he's just trying to spread fear and lies? No, that's not what it was. In fact, let's go back and look at what happened to the stock market in December of 2018. It started to crash. And why did that happen? Well, it was for the same reasons that it's happening today, because the Fed started raising interest rates back in 2016, little by little, gradually, much more gradually than they are right now, by the way. And a couple years later, that was enough to tip the market into a crash position. And they quickly reversed their course on raising these interest rates, and within 2019, they lowered the rates practically back down to zero, guys. So why is this important? Well, it's important because Robert Kiyosaki was actually correct about there being a crash. There was a crash on the horizon, and it was actively happening as he was predicting it. But one thing he didn't anticipate is the power of the Fed to interfere and prevent the crash overall. And that's exactly what happened, guys. They swooped in and prevented the crash. And we can see it right on these charts that I've put up on the screen. You can see it in the stock market, and you can see it with the interest rate trend as well. That just goes to show you, once again, how much power the Fed has to either cause or correct any type of crash, particularly in the stock market. And it happens very quickly with the stock market as well. But today, there's one big problem. They can't play these games like they did in the past. At least they can't without completely obliterating our economy. Why? Because we have record high inflation, essentially. So they've already stated time and time again, after every single meeting, after every time you hear Powell speak, that inflation is going to be the #1 goal for the Fed. They are basically set on crashing the market, guys. And they know that this time they pretty much have to do that in order to keep our country in a healthy position in the long run. So that's where we're at with it right now. And let me just say that back then in 2018, before I ever even started this channel, I didn't even know how important the Fed was or how any of this worked. I didn't realize why all this was happening, and maybe many of you out there don't either. And that's why it's important to get educated and to pay attention to some of these simple trends, like what the Fed's fund rate is, as well as the inflation numbers and what the stock market's doing, because all these things are related. And a lot of people will say, well, Michael, if the stock market crashes, that doesn't mean that housing's going to crash, because overall the economy is still strong and blah, 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 blah. But guess what, guys? If the stock market has a severe crash, like Michael Burry, he says it can come down another 50% from where it is right now, which would be a huge crash. And if something like that were to happen, what happens next? There's a ton of layoffs, okay? All these publicly traded companies that are hemorrhaging money are going to have to lay people off quickly. And who's going to get laid off then from this, guys? A lot of high-paid individuals that own expensive real estate, who have high house payments. And if they lose their income, they won't be able to pay their mortgage payments. So you can see how all of this is a snowball effect. And once the snowball starts rolling down the hill, it's going to be nearly impossible to reverse, even if the Fed did start lowering interest rates, because all these things take time to get set into motion. And once companies are laying people off left and right, you know, that trend could take a couple years to correct itself. So you need to be thinking about all these things as we're getting closer to coming into 2023, because a lot of you out there seem to think that what's happening right now is one of the only reasons things haven't completely collapsed yet, is because the Fed is waiting for the election to happen and basically keep things sort of artificially propped up until the politicians get their votes in. And maybe that is what they're doing. I definitely wouldn't be surprised if they are, but that's why you need to be prepared for the worst case scenario to happen coming into the beginning of next year, because it's looking more and more like that could be the case. Like this guy, Jeremy Grantham, he is a longtime investor out there, you know, old guy, been in the markets for, you know, decades. And here's what he said, guys. He said that there are shrinking corporate profit margins. There is high inflation. There's interest rate hikes. There's a food and energy crisis. There are pandemic disruptions. There is the Russia and Ukraine war. There are long-term issues such as aging populations and labor shortages. When you combine all of these things, he thinks that the worst is yet to come, because historically speaking, it's not that easy to claw your way out of this mess. He thinks that things are definitely going to get worse before they get better. And I think that makes perfect sense, because how can things just continue to get better when we have all these looming problems that need to be solved right now? It just doesn't seem likely, guys. I don't see the path forward. And this kind of leads directly into the last thing I want to talk about here, which is that ARM loans now have hit their highest level in 15 years. What happened 15 years ago, guys? The last economic downturn, okay? That's what happened. The crazy thing about this is that the average income is actually $165,000 a year for a lot of the people that are taking these ARM loans. And on the surface, that's a good thing, because that means that people with these higher incomes might be in a better position to take on a higher mortgage payment unexpectedly once rates do go up, okay? So that's kind of a good thing. But one thing that we're not looking at is what happens if all these people lose their jobs when the stock market crashes, which is totally possible, because my guess is that a lot of people that make $165,000 a year or more, A, have a lot of their wealth tied up in the stock market, first of all, and B, probably have some sort of job related to the performance of the stock market. Now, that might not be the case for everybody that makes that kind of money, but I'd be willing to bet it's the good majority of them. So this is why the Fed raising interest rates and the overall health of the economy and what the stock market is doing is so important when it comes to housing and whether or not people are going to be getting in trouble as things get worse, guys. So one of my viewers suggested that I make a video about what you can do, if anything, to kind of save yourself from all this inflation and economic disaster that we're facing. So let me know if you guys want to see that video. I can basically just give you some examples of what I'm doing. I can't tell you that, you know, I'm the perfect guy or I have all the answers, but I can just tell you what I see happening and what I do anyways, with or without this going on, to best be prepared for anything financially. So let me know if you guys want to see that video. If you guys enjoyed this video and you found it entertaining, please check out my next video on the screen right over here, and I'll catch you over in the next one.